Welcome to the Dividend Talk podcast, episode number 21. Why the balance sheet of a company is so important for us. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to this channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Hey everyone, we have a nice little show for you here today. We're going to have a chat about one of the fundamental statements, the balance sheet, which is one of the top three things you should be looking at, I suppose, when you're analysing a company. So we have done analysis of companies before, but we just want to give you a little flavour of what we actually look for in the balance sheet and how we dissect it. But before we get into that, how are you getting on, EGGI?
I'm doing well, actually. It was a really busy week at work. This fall has been extremely busy at our company, but I'm liking it. Lots of energy there. At the same time, of course, COVID-19 is all around us. I think we can make this Christmas song about it. But no, I'm feeling energized. I'm really ready for the weekend. Next week, there's also public holiday on Wednesday over here. So yeah, I'm actually doing really well, and lots of earnings this week again, but I'm a bit tired to talk purely about earnings, so I'm really happy with the topic from today. How about yourself?
Yeah, all good my end. A holiday midweek on a Wednesday, that must be nice. Breaks up the week quite well.
Yeah, definitely.
Man, I'm jealous.
Well. Hey, but about the news, right? That's usually our first section, so let me kick it off. I was really surprised by the gossips. I guess these are still gossips, or the rumors around AT&T that it's willing to sell its stake in DirectTV for 15 billion. We know that back in 2014 they bought the company for 67 billion. I mean, you got to be kidding, right? This is like less than 25% of what they paid for over, what is it, 5-6 years?
Yeah,
Imagine you buy a house, yeah, and you need to impair it and write it off with 75%. I mean, how would you feel? Because you still have the debt, the mortgage covering your house. How would you feel?
it must be I want to use the word embarrassing, but like it must hurt those guys who made that decision, because it was a pretty awful decision. And reading on Twitter, I think it was Investment Talk or someone mentioned that they could have bought Netflix for less money than what they bought DirectTV. And man, I'd say they look back at this now and just wonder, what were they doing?
Yeah, and I liked Phil. I think it was Phil who said, like, or maybe someone else, I don't remember, but wouldn't you have loved to be the fly on the wall there just when the decision was being made? And they say, yeah, let's go for DirectTV, 67 billion. Yeah, it's worth it. Let's get it. I mean, look at it, all the people watching TV. We can do, because I read the 2000. I think I read the press release of the acquisition. So they were thinking about effectively cross selling and selling bundles, right? So with the mobile phone and everything, all these packages, and they started doing that, of course, a bit in the beginning. But I mean, just the conversation there must have been so awkward. But imagine if you could have said at the time, let's buy Netflix and have it in a package deal with roaming, 20 gigabyte LTE, and then also, for instance, together with the newest iPhone. That would have been a killer plan. Not with DirectTV.
Yeah, I mean, look, we don't know what they were thinking at the time, but I'm sure there's huge regrets, as you say, and maybe they're just sick of it, and they just have this monkey on their back, and they're like, you know what, we'll take the loss, we'll take the hit, and we'll just forget about this. It never happened. We'll just pay off the debt. But yeah,
Well,
it's an expensive mistake.
yes, definitely. Hey, what's been your news of the week?
Yeah, so there's two bits of news that I was looking at. So the first one is with Walgreens. Obviously, I like that company, but there was talks of them doing a joint venture with a German company called McKesson, and I believe that's now got to go ahead, and they're going to go ahead. I'm still unsure whether it's going to be a public company or a private company or the exact details around it, but it does seem like a pretty good deal for Walgreens. So McKesson are a healthcare supply chain management solutions company, and they have retail pharmacy and stuff. So I think they'll work quite well together, and I'm interested to see a bit more details on how the company is going to be formed and what they're going to do with it. But look, it's another step in the right direction, I think, and more positive news. So hopefully they'll start driving that price up for me. And the second one is, I don't know how you feel about digital currency, but this one caught my eye because I had a conversation with my brother-in-law 2 weeks ago, saying that I believe that they're going to try and phase out cash. I believe that it's already began, it's started, and then on the ECB website, it just so happened they start talking about a digital euro, and they're going to start phasing in 2021, which is it's quite interesting to me. I have mixed feelings on it. I mean, from a technology point of view, I think it's great, but then cash is king, isn't it? So yeah, I feel like you're losing a little bit of control. So I'm a little bit on edge in it, but I'm still a little bit excited to see how they're actually going to play this out, and how a digital currency will actually fit within our ecosystem.
But is it supposed to be on blockchain technology?
Now, I didn't go too much in detail of the technicals behind it and how they're going to do it. I assume so, but I'm not sure. I'd imagine it will be. It make more sense for them to go that route, but
Because I consider my euros already digital. They're somewhere on my iPhone, on my iPhone, effectively, right? Somewhere stored on a bank account. I usually don't go to an ATM to get cash. So for me, they are digital anyway. So from that point of view, I think that wouldn't change a lot. It's the same as gold. When you buy a gold ETF or something like that, you never really have the gold in your house then, right? I know some people that buy physical gold.
yeah.
Yeah, it will be interesting to see how that goes. I think Europe often has a lot of those kind of programs where they're really investigating it, and I would just like to see that the euro starts to be a bit more productive and gets those projects to life, and not every time kill them via the back doors.
Yeah, no, it's something to keep an eye on. I get what you're saying. Our generation is, and certainly the generations after us are so used to everything being online, but it's maybe the generation before us, they don't really get to grips with online. So I don't know how it's going to work for everybody and how inclusive it will be, but it'll be interesting to watch it play out, and just to see how they actually integrate this into our system, and how it works with cash and stuff. So it'll be an interesting year ahead, I think.
Well, I don't want to be the party pooper, but we have only one generation left ahead of us.
ahead of you, I'm younger. So yeah, so that's all my news this week. Nice and light. So we'll move on to the main topic, which I suppose, as I said, we're going to have a look at the balance sheet. And I just want to point out that neither of us are financial advisors. We're both retail investors. So this is not financial advice or anything like that. This is just how we see the balance sheet, and what we look for. So if we get something wrong, feel free to tell us, but don't give out to us, because, as I said, we're not professionals at this by any means. So I'll start. I will just start basically explaining what the balance sheet is. So I said earlier, it's one of the three major financial statements. So you've got the cash flow statement, you got the income statement, and you got the balance sheet. Three very, very, very important statements, and they look at different things. We chose the balance sheet. We will do the other two over, I don't know, a couple of weeks or so. We're not quite sure, but we will cover them eventually. But what does a balance sheet show you? It basically shows a company's assets. So assets are things that a company owns, like cash, inventory, property, and it shows their liabilities. So what they're paying out, so rent, wages, taxes, loans, And then if you put them together, you get what's left over, and that's the shareholders' equity. The shareholders' equity is basically what me and you, that's our portion of the company. We invest in the company, that's what's left over for us. So that's basically in a nutshell what it is. And ideally, you want a company then that has more assets than liabilities. The more assets and the less liabilities they have, the more shareholder equity that is left over for you. So that's basically it. But we'll just go a little bit in depth then, and we'll talk about each one and what to look for in them. So if we start with the assets, okay. So the assets are usually on the left-hand side of the balance sheet, and there's a couple of things that you look for, but we'll start with the current assets, and current assets are assets that can be converted to cash in 1 year or less. So you have stuff like cash and cash equivalents, so your cash in hand, marketable securities, inventory, and prepaid expenses. So when you're analyzing for assets, what do you tend to look for in this section with the cash and marketable securities? Now, I don't really understand marketable securities, so you might know a little bit more than me on them.
Yeah, so let's say like that. First question, what I look into is really how much cash do they have on the balance sheet. And I think, for instance, Microsoft is a really great example there, because this cash is so liquid, they can usually quite easily use it for instance, share repurchases, or the best one, acquisitions. It gives a lot of flexibility, having a lot of cash. Think about it yourself. If from your assets, if you have a house and everything, a car, these kinds of things, but also let's say 30% in cash, and then there comes a major stock market correction in like in last March, you can really buy a lot of stocks. And if you don't have cash, you're kind of handcuffed and you cannot use that opportunity. So that's why cash is so important for me there. Other than that, I also look a little bit at inventory, but it really depends on the how is it on the sector the company operates in. So often I prefer inventory actually not to be too high, because it might be actually a negative sign for me, because you want those products to be shipped and sold as quick as possible. But those are actually the only two that I really look at. And marketable securities, those could be, as I understand it, like for instance some bonds or something like that you can quickly liquidate again, or I don't know if this is the right term, but sell. So also that you sometimes I even put them on top of the cash and cash equivalents, just to get a feeling for how much cash is there for this company.
And then in terms of long-term investments, then so you've got like your fixed assets and your intangible assets. And for me, intangible assets, I look at Coca-Cola, for example, and it's their brand name more than anything that's their asset. And it's quite hard to value that and put that into context on a balance sheet. So when I'm analyzing a company, I don't really like intangible assets to be too high, because you can't convert that to cash really for me. So it's something that I like to see, but I don't like it too high on a balance sheet.
But here again, I would really recommend to compare companies within a sector here. For instance, if you go to the software industry and look at Microsoft, of course, they have a lot of intangible assets. I mean, their whole Windows, Azure, all these patents, everything that they have, it's all intangible assets. And those are really important. But also pharma companies, they have a lot of R&D on there. And this R&D, they are typically always impairing. That's why I have always this issue with pharmaceutical companies, that they every time they need their core earnings and not the GAAP earnings, because from the core earnings they deduct the R&D impairments effectively based on how the pipeline is progressing. But those are all impairments on the intangible asset side. On top of that, there is also goodwill. And goodwill is the one in intangible assets that I always check straight away, because that's the one I don't like. All the others can be inflated, right? So it's always important to consider. But goodwill is the worst one for me, because goodwill means that a company paid more than the actual enterprise value, let's say, or the worth of the company at the time. So they pay the premium for it, and then they always use synergy and blah 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 blah. Now, take as an example, we spoke about DirectTV not that long ago. They paid a significant amount of goodwill for DirectTV, and all that goodwill is poof. If they sell it later, really for 15 billion, you can expect a really really big hit to the balance sheet upcoming for AT&T.
Yeah, but goodwill is not always a negative sign. I
No,
mean,
no.
I've been reading Buffett a little bit, and I have one of these books actually that goes through the financial statements, and he believes that if you're buying a company that has a competitive, durable advantage, you're not going to buy it at fair or market price. So
Sure.
you do expect to buy it at a premium. The problem is, as you said, if they're buying companies such as DirectTV that clearly don't have a durable competitive advantage, that's when it becomes a problem
Yeah.
to me. So
So either, yeah.
yeah, it's not necessarily a bad thing, but it definitely does depend on the company that they're buying and how they integrate that company and how it fits with them.
So what I typically do, and this is just a rule of thumb or back of the napkin, for me, when goodwill is more than 10% of the asset side of the balance sheet, I want to study it more. I want to understand how was that goodwill created over time.
Yeah.
I know that this is not probably the best accounting approach, but it helps me to when I'm scanning a balance sheet to quickly dive deeper, because everything more than 10% means that you're paying more than 10%, let's say, for your assets. And then I'm wondering, like, to your point, okay, so was this then a high quality companies that they've been acquiring for which it was worth to pay a little premium on top of that? Or is there something else going on here? And usually such a rule of thumb really helps me here.
Yeah, no, it's good to have a rule of thumb, especially as retail investors. As we said, time is of the essence. I mean, we can't study these like the professionals can. So to have
Yeah.
a little rule of thumb like that to say, look, if it's over 10%, give an extra bit of detail is pretty sweet.
So then we have also the liabilities part of the balance sheet. Would you like to say a bit more about that?
Yeah, I mean, liabilities is basically what the company owns to outside parties. So you typically want these to be on the low side, don't you? You don't want them too high. And again, you've got current liabilities. So these are debts that are due within within a year, and then you've got long time liabilities which are due any point after that year. So typical examples, I suppose, of current liabilities would be your dividends that are paid. You've got bank indebtedness, you've got interest and wages and accounts payable. So they're typically what you look for on it. And then you've obviously got your long-term debts, which are interest and principal bonds. And something then maybe, I'm not too sure on it, but there's a deferred tax liability, and maybe you might give a little explanation on what that is, but I see quite a bit. And it's, I don't know, it's obviously the tax being put off a little bit down the line, but
Yes. So what how I understood this specifically, remember that America did this kind of, I think it was in late 2017, that they allowed companies to have overseas money being transferred to the United States as kind
yeah.
of this tax-friendly was a policy. I believe that a lot of, I think it was Apple, but don't shoot me when I'm wrong here, but I believe like companies like Apple had a lot of money overseas, which they had a potential liability on tax on, and I believe that was the part of the balance sheet, but I'm not 100% sure anymore.
Hmm.
Yeah, but think about your own, how you say it, your own home situation. If you have tax due and you're pushing it out to pay that, and the local IRS, for instance, you can get a deal with them to pay it later, then probably that would go also to the long-term liability point. And I know, for instance, a friend of mine who has a company who got into tax troubles because of international business within Europe. And this person now needs to pay a lot of tax still to the local IRS here. And I'm sure that this is a deferred tax liability because he cannot pay everything off at once. So they made a deal together with the tax office to pay it over the upcoming years.
Okay. And would this typically be with companies that struggle for cash flow, or would there be a genuine reason why they'd want to do this?
So in the case of my friend, it's a cash flow issue that they can't pay off all that debt at once. Other than that, I don't know. So yeah,
Okay.
I look more at the personally at the long-term debt and about and at pension fund liabilities and such, because there's always some trouble around pension funds.
Yeah, and we'll see that. You'll probably give an example later of UPS, which obviously has huge trouble with pensions.
Yeah.
So it'll be good to explain that a little bit further. And then I suppose the last bit of the balance sheet will be the shareholders' equity, and I suppose this is the most important number, isn't it? On it, you're looking to see how much is left over when you subtract the liabilities from the assets. So I mean, I don't really have a figure in mind or a percentage in mind. I just like to see that equity is going up over time. I just track it over the last 5 years and 10 years, and just to see that it's going up incrementally, because you don't really want the liabilities climbing more every year. You'd like to see that their assets and that they're actually making money on that.
But isn't it really nice when you think about it? We are part of the FIRE movement, right? Financial independence, retire early. And one of the things that many people track on a monthly basis or quarterly, yearly basis is our net worths.
Yeah.
So literally shareholders' equity is for me just net worth. We should just create a petition to the people that invent gap and everything, and just tell them to change it to net worth, because that would resonate much better with us, because that's what it is. So we want to grow the net worth of ourselves, but also of the companies. So our portfolio that we accumulate with dividend stocks eventually end up in our net worth. So the sum of the net worths of our companies should be growing, and then we will be growing also in net worth, is the idea, right?
Yeah. No, that's a great way to look at it. It is essentially the net worth of the company, and you're right. If a retail investor like us was to see net worth of a company, you'll definitely pay attention to that. It'd be the first.
Exactly.
It'd be the first thing you'd look for on that.
Yeah. And then that's interesting, because maybe it's good to mention there you have the accounting post, which is called retained earnings. And retained earnings is typically the earnings that you take from the income statement. So if you think about how the income statement is connected to the balance sheet, the profits that a company makes or the money that it earns goes into the retained earnings. And when it makes a loss, it deducts from the retained earnings. So that's why you will find it back when you wonder where does the income go to on the balance sheet.
Yeah.
Okay. So maybe we could take some of those things, right? What we just discussed, and then we were talking a bit about what we are looking at. So we spoke about goodwill already. For me, pension liabilities, like I mentioned, are also really important, because pension liabilities are effectively debt that you owe to your current employees in the future. Yeah, so it's an obligation you have in the future to pay them. And I will soon show the the example of UPS, but in my opinion, this can really bring some companies into trouble. Also think about General Electric and such, if there's too much pension outstanding, and specifically when the pension is not fully covered, compared to what the future obligations are. But then maybe it's now a good time to connect this to some of the popular ratios that people in the FIRE movement use, because we often hear debt to equity as an example. And so why does that need to be low, right? So I prefer personally below 60%. Again, it depends a little bit on the sector that companies are in. But this comes to the point of, again, having flexibility. Yes, so you can increase your debt in bad times to make use of opportunities, as an example. And if you have too much debt on your balance sheet, your credit rating will be lower, will be also for us personally if we then go to the bank, and we will not be able to get something. So if I would be going into real estate investment here locally, and I would like to buy a flat for renting it out, if I'm fully maxed out on my debt, they will not borrow me money. Yeah, so that's where the credit scores come in. Hence, a debt to equity ratio, I prefer to see that rather on the low side, so not more than 60% for a company.
And when you're calculating that, are you using the long-term assets and long-term liabilities, or are you using current assets and current liabilities?
I'm using long-term debt
Long-term,
typically,
yeah.
unless there's a too big deviation between current and long. If there's something specific, but usually long-term debt. Yeah.
Yeah. I should point out that I use a website here called readyratio.com, and it's fantastic. You put in a company, so you can put in UPS, so you can put in any company, and it will compare each ratio against the industry, and then in the next column also against the whole index, the whole S&P
Nice.
500. So it's really nice. So I don't have a hard and fast rule of under 60%. Generally, the lower the better. I do like it really low. But I will check against the industry, and if it's below the industry, I'm generally happy. And obviously, if it's above the industry, then it's a red flag for me.
Well, it will be great if you share the link, and we'll put it in the description of the podcast. Super. Yep. So another one that I typically look at is the current ratio. And the current ratio is current assets divided by current liabilities. So think about having, I don't know, 10,000 euro on your cash account. Yeah. And you have, for instance, 8,000 of, or let's say 10,000 of credit card debt. Yeah. That is due within the next year. That means that you would have a current ratio of 1. So I prefer current ratios again higher. That means that I effectively have more cash than that I have short-term debt, and this really gives a lot of flexibility here. Because again, if you quickly want to do something, quickly want to make use of opportunities, then you can really use that cash, and you also don't get too quickly into trouble, short-term trouble, if you need to pay some unforeseen bills or something like that. And the same applies to companies here.
Yeah, I think Google is a really good company to look at here to check out their current ratio. The last time I checked, it was above 3, which is crazy. So that's basically saying that their current assets is 3 times greater than their liabilities. So if they got into trouble, as you said, and they needed to pay all their liabilities, they would still have 3 times enough money left over. So it is a really, really important number. Like you, I do like it over. It definitely needs to be above 1. Anything above 1 is certainly a red flag, but I do like it to be 1.5, just to give it that little bit of flexibility.
Yeah. And then another one that I find really important is the return on equity. There's the famous Buffett indicator, I think, that many books are written about. And this is effectively net income divided by the shareholders' equity part, so the net worth part of the balance sheet. And here you would like to see it, let's say, if it depends on your target, right, what you invest in. But for me, I'm looking at a 10% genuinely, usually, or that's what I prefer. 10% or above. It's not always the case. So sometimes you need to look at the catalyst for the company if they can move up from there. But this would be like actually telling you that you will be making a 10% return on your net worth every year, right? And this is for me a really important yardstick as a company, because many others can be easily manipulated. Return on equity is a bit more difficult, unless return on equity is not always so useful when you have, for instance, a lot of share buybacks going on in the background. And I'll show one soon, also an example there, because it might really squeeze, I said, negatively impact that ratio, and then you need to adjust a little bit the numbers you use to come to a reliable return on equity.
Yeah, and it is also a good one to compare against the peers in a particular industry and sector, because I mean, you want to get the best bang for your buck, don't you? So
exactly.
I mean, it is a great yardstick, as you said, to compare against other companies to see what they're earning over a period of time and what you expect to earn. So yeah, no, it is an important one. Again, like that, I don't have a hard and fast figure. I do just compare against the industry, and I like it. I like it to be around what the industry is making. So if it's below the industry, then it's again, it's a red flag for me.
Yeah. So for me, there's just one issue with the balance sheet. By solely looking alone at the balance sheet, is that it's a snapshot in time. It doesn't say you anything else there. So what I typically do, and what I also like, is when companies put multiple years of the balance sheet at once and compare them. Usually they do the current year with the former year, but I actually prefer the last 5 years, because then I can see the trends. For instance, for me, the trend in long-term debt is important. I prefer to be conservatively, if it grows really conservatively and less than the whole balance sheet, let's say, as a total, because that means it goes more to the owner's equity, as an example. I would like to see the cash trend there. I'm not saying it should be only going up. I just want to see what the company is doing with their cash, because if they acquire companies with it, then I'm more than happy with it. And I want to see, of course, the owner's equity or the net worth trend of the company. Those are three really important for me to, where I want to compare them year over year, and preferably for the last 5 years.
Yeah, I agree. So we might just talk through some examples and maybe the UPS. I know you have a slide here that will show on YouTube. But we have UPS and the pension liabilities. If you just want to talk through what you kind of see there.
Yeah. So UPS is a really interesting company because they have a total balance sheet, of 57 billion. Now, just alone in 2019, 10.6 billion, so around 20%, is consumed by pension liabilities. Honestly, I don't think it's for any company a good shape to be in, that you have so many future liabilities to current employees of such an amount, which cover 20% of your balance sheet. And these are two red flags for me. Generally, it means like this is a liability that usually just keeps increasing by the how you say it, the deals or the agreements or the contracts that you have with the employees, right? For inflation compensation and such. Secondly, I don't know if you give a good sign to your employees that, for instance, your company might be at risk by, for instance, having the pension funds underfunded. And this is exactly the case, because the funding ratio at the moment stands at 87% for UPS. That means that they are underfunding the pensions funds. Now, people, for instance, in the Netherlands, they hear all the time in the news like that the pension funds in the Netherlands, they need to have a ratio higher than 100%. Otherwise, they need to, how is it, ask from the current employees to pay more to contribution, or they will get less money when they are retired. Think about that they are always talking about 110%. UPS is at 87%. So what has been happening on the free cash flow the last few years? In 2017, they paid 7.2 billion to the pension funds, which meant that their free cash flow was negative 3.7 billion. Here they do some financial engineering again, because they then report the adjusted free cash flow, which then comes out as a positive 3.5 billion. Please don't look to that. It's cash. It's gone. It's just manipulation to take that out of the free cash flow. In 2019, they paid an additional 2 billion contribution to the pension fund. This is almost 10 billion over the course of 3 years. And this is a shitload of money, which is not going to the shareholders, which is not increasing the net worth of the shareholders. And this is exactly why I pay attention to that. And this is also the reason why UPS for several years went nowhere. I mean, not solely due to the pension funds, but because, of course, business operations is the most important, right, here. But what you see is that to the point earlier, when you have a lot of liabilities, it reduces your flexibility to do things. For instance, acquisitions. And we also know that their credit rating went a little bit lower. Actually, that was in the credit report actually mentioned as a major reason the pension funds. So UPS is a company that struggles with that.
Yeah, and it's a trend that you'll see. I know you have a 3-year snapshot here, but if you go back 10 years, you can see that repeating itself over and over and over again. I think, again, they were negative in 2014 as well. So it definitely will be a concern to me. And when I looked at UPS balance sheet recently before we did this podcast, and it's horrendous. It's really hard to get a good judge on what they have and where it's going. Free cash flow is up and down.
Yeah.
It's all over the place, and certainly not something I would be looking for in a company.
Yeah, you need to. I mean, we talk numbers now here based on the balance sheet, but think about the real world implications. This is a reason why companies like UPS want to have as much as possible contractors, because with contractors, they don't get these pension obligations. What does it mean to society? Society doesn't like all this geek work naturally, because they don't have psychological safety, and they are not building their future, because what really happens, the pension obligation transfers from the company to the employee. Yeah,
Yeah,
so the employee is subsidizing, and the employee is probably already on a low, relatively low salary, that they cannot, for instance, pay 10 to 15% of their salary into every month into a pension fund. So this is really like just shifting the obligation to the employee, and I think Uber and other those companies really benefit from that. And I think this has impact to society, and that's why there's those companies are often in the news regarding to using contractors over employees.
yeah. Okay, and then we might look at AT&T, which is another, maybe General Electric as well, but they're two really
Yeah.
popular companies, I suppose, in our them on Twitter and stuff like that. So we might have a little talk about the goodwill portion on this, and we know we just had a chat about they acquired DirectTV and stuff. So we might
Yeah.
just talk through that a little bit as well.
So in this case, AT&T over 2019 had a goodwill of 146 billion. Remember that. The total balance sheet is 550 billion. So we're talking here about, now out of my head, 27, 28% of the balance sheet being consumed by goodwill. That's a lot for those kinds of intangible assets. Yeah. And this is, I think this is the biggest number from all the other accounts in the in the, how you say it, in the long-term asset part. So most of it goes to goodwill from that point of view. Now, then, if you think about if they would sell goodwill, what that will do, yeah, to the balance sheet, it would shrink it with at least 40 billion or something like that, and that would again have a large impact on their how is it, on their stakeholders' equity, which is still, to be fair to the company, at 200 billion at the moment. So it is not straight away putting it in minus or something like that. But it would have a large impact, and I think credit rating for AT&T could also be again at risk to be lowered. But let's look then at a company that not too long had this issue, General Electric, back in 2018. They had to write off 22 billion in goodwill. Yeah, 22 billion. So at the time they had 83 or 84 billion in goodwill on the balance sheet in 2017. Then they wrote off 22 billion, so their goodwill became 60 billion. Actually, the balance sheet overall that year, it was a horrible year, went 60 billion lower. But what happened there as well is that their, let's call it their net worth, yeah, reduced from 73 billion to 50 billion, which is a really, really, really substantial. So imagine you lost 30% of your net worth in 1 year, and goodwill was a really large contributor to that. That's what happened here. 30% of net worth, poof, gone because of impairments. Yeah, and this is why, and we all remember in General Electric back in 2018, they also had the dividend cut and everything. That was a kitchen sink here, all came
Yeah,
together. And these are these kinds of impairments that you really don't want to have. And often impairments, they go by the back door out. You don't really see them because there's strong income, a strong income statement behind it, which covers it up a little bit, so you don't really see it. Yeah,
yeah,
because then you get the retained earnings minus the impairment. Usually, you have more retained earnings than impairment, so it's still a net positive result. But General Electric went bad, and that's why I'm not increasing my position in AT&T, because I think this kind of stuff worries me with DirectTV.
Yeah. And it's interesting then that you mentioned retained earnings, because that's your link back to the income statement.
Exactly.
So I know you have a sheet here for Starbucks that has negative retained earnings, which might be interesting how that plays out.
So the negative earnings from Starbucks is actually since recently. And there's one really, really simple explanation for that, which is called share buybacks. So I think they, in 2017 or 2018, they went from a positive retained earnings to negative retained earnings, because just in the, it was from 2018 to 2019, because just in 2019 alone, they bought back 9.5 billion of stocks, which I think is even I need to, I don't, they had, at the moment they had a net earnings of 3.5 billion. So just in 2019, they bought 3 times more stock back than they earned in the same year, which meant that it went negative in the retained earnings. And that's why sometimes on the balance sheet you see negative shareholder equity and negative net worth. And that's what Starbucks has actually, because Starbucks in 2019 on the balance sheet had a negative shareholder equity, and they call it not equity anymore. They call it shareholder deficit of 7.8 billion. And that's really interesting. So their total liabilities are 37 billion, and then minus the or let's say plus the negative shareholder equity, comes to a total balance sheet of 29 billion. And remember, again, by itself, this might not be such a problem if you believe in the earnings power from Starbucks going forward. But we know they've been buying also back again in 2020 and increasing the dividends. So the question is this sustainable? What I honestly believe is that Starbucks is really propping up the share price at the moment, and this is not sustainable. So if growth starts to slow, for instance, by the expansion of new stores in China or something like that, I think their dividend growth will be at risk. I think we will see really slow growth, and they will need many, many years of strong income and cash flow to start recovering the balance sheet a bit back again. So they're really, how you said, they're really taking their future earnings, they are taking them to today to reward the shareholders today, but it's really a loan on the future. And that's how I look at it. And that's also the reason why I never started a position in Starbucks. For that reason, I have it in my desired portfolio, because I still think they can get away with it with such a strong brand. But for that, I'm looking at the share price there are $50, and I think it's around 85 or 90. So for me, it doesn't even come close.
Yeah, you need to have a strong feeling that the company can keep increasing their earnings over the next 10 years.
Decade.
It's a risky strategy, and you can understand it if they want to reward their shareholders now, but I'm not so sure. I've never been too sure on Starbucks, as I said before. I know they are a good company and a great brand, but how can they keep growing at the rate they're growing? I'm not sure. So it's a company that I've never invested in and probably won't. But yeah, it's too risky.
So I hope to our listeners, we some of you might actually know much better than us about the balance sheet, but I also know that we have quite a large following that are relatively new to investing, maybe just for a year or two. So I hope we clarified a little bit about how we look at the balance sheet, and also gave you 3, I think, really good examples of companies where if you now yourself open up the annual report, look at their balance sheet, you will probably see what we mean. We will put the pictures also in the YouTube video for clarification. And I just hope that by sharing some of our knowledge of what we learned over the last year, we also help you a little bit to spot those things easier when you're doing your own analysis.
And of course, if you have any questions and you need any guidance, just reach out to either of us, and we're more than happy to pass on what we know. Cool. So we move on to the listener questions. And the first one is actually a pretty decent question considering the topic, and it's from Eli Snowball. And he asked us, what do you think of the practice of issuing shares to pay the dividend, which is very common in Europe?
So I'm not a fan of it, to be straight here. I prefer them to just pay it with the cash flow straight away. Eloy Snowball responded a little bit to the practice of Danone doing this and Shell. So I looked up on Danone, and what I saw is that the shareholders actually voted for this practice. So they voted for share dilution, I guess, to protect cash a little bit, and the balance sheet. But it's like left pocket, right pocket for me here. What I can tell you about Shell, I really liked it in 2016 because they were preserving the balance sheet at that time as well. They did some dilution and then later used share buybacks for it. But what was the nice thing about Shell, because it was dilution really there, I didn't pay dividend tax on it. Because if you think about it, if they pay you dividends in cash, yeah, you need to tax. But if they pay you dividends in stock, and the stock is really share dilution, like pure share dilution, then you already paid for it by watering it down. So hence why, in this case, with the Shell shares at that time, you didn't need to pay dividend tax during those few quarters, which was for me good because I could, didn't have a tax impact, and trusting on the company to use the balance sheet later to buy back. Of course, this year they've got a dividend, so it didn't last too long. But if there are no tax implications, I like it. Otherwise, I prefer just to go straight from the cash flow.
Yeah, good point.
And well spotted about Danone. I didn't spot it when I was reading the annual report. And then maybe this question for you from Phil. There are 4 characteristics, but you can only choose 3. What would you choose based on your dream company? 1, they have a moat, really strong moat. 2, they have strong growth. 3, trustworthy management. 4, a solid dividend history.
I seen this question come in earlier from Phil, and I was like, "Oh man, that's a good question. Can I choose all 4? No." I suppose I definitely want them to have a strong, like a wide, like a strong moat. You want a company that has, as I said, competitive, durable advantage and the ability to grow over time. So I think the first 2 are definitely top of my list. Strong moat and strong growth. Need both of them. And then I've been racking my brains over trustworthy management or solid dividend history. It's a tough one with the management. Managements change, so it depends on how are they untrustworthy. Who are they untrustworthy to? But I think it's important to have good management in there over a solid dividend history. I'm more concerned about the history or the dividend going forward than looking back. Of course, you do like them to have a good history, but if you don't have management that you can trust them, and we've seen this, we've talked about companies recently where management have gone in and companies have gone downhill, and it's really, really important to have good management in there. So for me, it's A, B, and C.
Yeah, I would say the same. Okay, next question then from Centrino. Any idea why in this week of the USA election, I think there's voting for president, I believe, this week. I can't remember.
Something's happening over there. I don't know.
Something like that, yeah. And the votes are counting uncertainty. The days were green instead of red. So why did we see lots of growth this week in the stock market? That's really the question.
Yeah, it's crazy. I was expecting maybe a little bit more red. I suppose when it started, it looked like Biden was going to be a clear winner early on. You could see there was a bit of red in the market. Then there was a rally from Trump, and the Nasdaq grew 3%, and it's pretty much grown since then. I'm not too sure. I think there's a little bit more certainty about who the president's going to be. I think it's quite clear right now that Biden is going to be the new president. Markets like certainty, and at the moment we may be seeing an uptick in that. I do expect some sort of pullback. I do expect, you mentioned the Trump premium before. I do expect some sort of catalyst to drive it down, maybe 10%. But at the moment, I think the stock market just likes the certainty of knowing that this won't be drawn out for weeks and weeks and weeks. It's going to be over pretty soon, I think. And maybe that's why it's green instead of red. Who knows? But that's my guess.
So my theory here is that last week when we had lots of red days, I think investors were expecting Biden to win. And now that it is a really close call, and they know that Biden can't even, do anything with, for instance, the former tax cuts from Trump. If they, for instance, they have more senators in the Republicans, he cannot do anything. So I think that probably relieved the market a little bit. With such a close call, they know that it's like almost 50-50. Whoever gets the president, but if it's Biden, he cannot really do a lot. That's my feeling here, and that was probably a relief to the stock market. But I also think that COVID-19 played a role with all the lockdowns on top of that, which then is good for the growth stocks, which we saw rallying really this week. Yeah. Okay.
He did ask a second question, and it's any idea why Geo stock keeps dropping 5 to 10% every day?
No.
I don't know too much about the company. I believe they are a REIT, real estate investment trust, but I'm not. It's not someone that I follow or know anything about really. So I'm not sure. I would suggest maybe check. I don't know what market's doing. I don't know what they rent to, so it may be worth checking out the overall industry and seeing is there any headwinds in the area at the minute that's causing the drop.
Yeah.
Okay, and then we had a question then from Investingly, and he asked, do we have any opinion on Rio Tinto?
Yes, I have an opinion on it for what it's worth. So I've got still some shares in BHP Billiton, which is a strong competitor of Rio Tinto. And I was looking into Rio Tinto a few years ago, but then one of the dams broke, I think somewhere in South America, if I remember correctly. And it was just a mess. And that's where I saw that management at the time was really with the head in the sand. And that was the time I told myself, okay, to the earlier point, trustworthy management, I'm staying away from this company. Having said that, also my experience with BHP over the last 4 or 5 years, I don't like this sector. I will probably stay away from it in general. I know they have juicy dividends, but these are not the companies that I feel investing in generally.
And then we have another question then from Sego Investor. When do you buy companies that are always expensive, the likes of Johnson & Johnson or Nestle, premium companies that always seem to be expensive? When would you typically buy them?
Buy the dip. So I just bought Johnson & Johnson on 135 at a 3% yield. I think Johnson & Johnson is actually not so expensive, but if you look at their yield, you might not be satisfied with a yield under 3%. Yeah, so I wouldn't it suggests a little bit maybe the yield trap here because if you look at J&J, I don't find them so expensive. Nestle, I find it a company which I analyzed. I want to stay away from it. I don't like the direction where it's going. It has hardly proper top line growth, and you need to read my post on my blog to see why not. Procter and Gamble, I think this is a company that typically goes through seasons. 1.5 years ago or 2 years ago, you could pick it up for really, really attractive prices. I think $60-$70. So I think with some companies, you just need to wait a little bit. But Johnson & Johnson, I would honestly say I find it attractively valued now. Yeah, right. Between 130 and 150, you could really initiate a position, buy some small tranches, not too much, but just nibbling in. It's a good price at the moment, Johnson & Johnson.
Yeah, and I can see the point. Sometimes it is hard to get through that psychology of companies that look expensive. They may not be expensive, but they may look expensive. And I had that with Visa. I always see them as being expensive or overpriced, and always predictably have good earnings, good solid growth, and the price keeps going up as a result. And I end up missing out then on what I could have bought 6 months ago because I've hesitated. What I do and what I tend to do is like you buy in small tranches. I've started to do that with Microsoft, for example. I have a price I want them to get down to, which is under 185, and then I'll buy a chunk of them. But what I'm doing now at the moment is I'll buy a couple every week, or maybe once a month, buy some and try and average in and buy the dip, as you said. Phil will love that one, but it's hard from a psychology point of view. But you got to remember, these are premium companies, and are
Yes.
companies that Johnson Johnson, for example, you buy him, you lock him up, you forget about him, and you come back in 30 years' time, and they're still there. They're those sort of companies that they'll be there for forever and ever. So it's probably worth paying a premium now, because they will continue to be there for decades.
Okay, then we have Louis. So let's take this question. What do you think about defense stock, like for instance General Dynamics?
I mean, defense stocks have a place in your portfolio. I don't particularly focus on them any more than any other sector or any other type of stocks, because I look for value. And depending on where the value is and what it is at the time, it might be defense stocks in times of uncertainty. You might see more value there, or you may see value somewhere else. So for me, it's not a huge deal. You can consider Johnson and Johnson maybe as a defensive stock, for example.
Yeah.
I don't pay too much attention to it. I just look for value in the market at a particular time, and depending on cycles and different elements like COVID, different sectors become more apparent, and that's where I put my money.
So for me, because I believe that he also means with defense stock, like stocks that, because General Dynamics is such a stock from the military, yeah, that selling guns, yeah,
Oh,
exactly.
Yeah.
So, I mean, I don't own them. My wife would probably not agree, but I see them in the category as sin stocks, like tobacco. Honestly, if General Dynamic would be a really, really good value, I might consider it. But I'm a hypocrite when it comes to sin stocks. So I don't want banks. Probably I wouldn't really feel comfortable with little boys carrying a gun and knowing that I'm earning from it. But I have no issue at all with smoking and these kinds of things, or pharma stocks with high prices. So I'm really a hypocrite. I know that. So yeah.
From that perspective, we spoke about ethics before, and I think I mentioned, for me, it doesn't come into it. I mean, you mentioned there are little guys carrying guns, and that's going to happen whether you invest in that company or not.
Yeah.
People are going to smoke whether you invest in that company or not. So I tend to stay away from the ethics side of it. Don't shoot me, but I'm here to make money and to build my retirement fund, and that's generally what I look for. Of course, you would like to cut out all those bad things, but they're there, they happen. So I have no problem investing in companies like that.
Yeah. Really quickly, then Louis had one more question, which I think is interesting. Is do we have any expectations around the minimum dividend yield if we buy?
Typically, when I'm doing fundamental analysis and I have a lot of it automated, but I look for 1.5 times the S&P, whatever the dividend yield is at that time, and that's my base point. It doesn't mean I don't choose companies underneath that level. It's just a quick screener. Like, for example, Visa, for example, if they were underneath, if they were 1%, they're still high growth. There is always exceptions, but for the majority of the time, I do tend 1.5% above the S&P. Kind of keeps me happy.
Yeah. So for me, it needs to be a really, 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 really special company. If I would buy a company with less than 2.75% yield, I put that there a little bit because otherwise it means that I need to pay more of my salary to reach my retirement goals. and it will really slow down my retirement plan. So it needs to be a really special company to go down that threshold. Preferably, I always said 3.25%. I reduced it to 2.75% because of all this money printing that's happening, stocks inflated. So 2.75 now, but I could buy below only when it's a really special company. Okay, then we have Eduardo Garcia. Are there any other holdings outside of Berkshire Hathaway from Uncle Warren that any of us would be interested in?
Nothing comes to mind for me.
No? For me,
No.
Johnson & Johnson. If there's one example of a holding company, it's Johnson & Johnson. I know it sounds awkward because I think what he's referring to, Eduardo, is like someone like Warren Buffett that is really investing, right? But if you look at Johnson & Johnson, it's a pure holding company for me, pure holding company. And there are more of such companies that give a lot of independence to the companies that are part of the group. And we have also some European companies here. I believe Unilever has this as well. And there are quite some companies that structure themselves as a holding, and they call themselves even a holding company. So
Yeah.
don't make the mistake that this is only a rich billionaire or something like that. But Johnson & Johnson for me is a really good example of a pure holding company.
Oh, good stuff. I didn't know that. That's interesting. Okay, thanks to everyone for the questions, guys. Great questions again. Really make us think and put us through our paces. So appreciate all of them. So we move on to the next section, which will be the stock pick. We got some feedback on this actually from Dividend Dane, and he was right. He said we weren't giving this the attention that it kind of deserved. We were picking Danone maybe 2 or 3 times and companies like that. So he made us a few suggestions, and I think we're going to take him up on it. And I'm going to pick a stock this week that maybe that I won't buy or recommend, but it's a company that it's an Irish-based company this week, and might be a company that you don't know anything about, and it'll be interesting for people to maybe go and look them up and see what they're about. We're going to try and not pick the same stock every week. We'll call it the Danone rule. So we'll try and stay away from picking stocks consecutively and just try to give, I suppose, a bit of a European flavor and try and choose stocks that maybe people are not aware of or may find interesting. So I'm going to start this week with, as I said, an Irish stock called Smurfit Kappa Group. So their ticker is ISE for the Irish Stock Exchange, and it's SK3. So just a small bit of a background about them. They are a mid-cap company, so they have a market cap of 8 billion. So mid-caps generally have between, I think it's 2 and 10 billion. So they're right at the upper end of that. And they are a packaging company. So they serve companies like Danone and P&G. So they have a huge international presence, actually. There's lots and lots of companies. I just gave 2 examples of companies that they serve. They operate in 3 main segments. So the first segment is their eSmart segment. And this really guides companies through 12 areas on how to optimize their e-retail process, which is quite important these days, getting yourself online and building an online presence. So they take companies and guide them through that process. The second segment then is Supply Smart, and that really then helps companies to optimize their supply chain, which again can be quite important. And then the last one is called Shelf Smart. And this is, if you think about it, when you walk into a shop, you walk into your Aldi, you walk into your Lidl, and they have products in particular places for a reason. Everything is designed for a reason, and it grabs your attention. So they really do help companies and design this and optimize this to increase their sales, which to be honest, I find really interesting. And I know there was huge studies done on Lidl and Aldi, and they even moved the section. When you walk in and you walk into the breads, and the smell hits you, and your fresh bread and cookies, and you just automatically drawn and you buy them. So it's a really interesting segment to be involved in, and they seem to do quite well. And I think their 2 largest customers are Lidl and Aldi, actually, which is quite good. So we just have a little look at their financial side. They've been paying dividends since 2011. Now, with Irish companies and probably most European companies, dividends is not their top priority. So they have cut the dividend before, which would be a warning sign for me. They cut it during the last financial crash, which was 2011. But since then, they've continued to pay and continued to grow. The current price is roughly 34, 35 euro, which gives them a decent dividend yield of 3.37%. And they're really conservative with their payout ratios. So it was 45% from their earnings, but only 10% of their free cash flow. So there's plenty of room for them to keep paying dividends if they want to. Now, I have mentioned it's not their primary concern, so I wouldn't be surprised to see them cut it again. But the potential is there for them to continue to pay it. I had a look at their last earnings, and they're showing solid growth year on year. They had a growth of 3% in Europe, but also in America they're growing very, very strongly. I think it was 11% over the last this year compared to last year. So it's quite an interesting company. I would recommend people look into them a little bit more. Their financials look really, really good. They have a strong balance sheet. As you said, that free cash flow is growing constantly, plenty of room for growth. The only thing that concerns me is it's not their main concern. I could see them cutting the dividend again if we run into another financial crash or something like that. But look, it's a really interesting company, and I would definitely recommend checking them out and let me know what you think.
Thank you. That was really cool. I never heard of the company, and honestly, if I would ever see the name, I would even skip it because Smurf in Dutch means these blue little animals from this French cartoon, the Shrumps, I think. And so, so it's a really interesting story. EMF.
Yeah,
really nice one.
If you Google top dividend paying companies in Ireland, I imagine that would be top 3. There's not many that pay. There's maybe 4 or 5, and this would be one. So they will be one of the better ones in Ireland.
Nice, good one. So you put the bar high for my next week's stock pick. Thank you for that. Okay, so I think we are coming to the end of the show. This was a long one, I think. We spent quite some time on the balance sheet, also to sharing our knowledge. Sharing is caring, and hopefully for us it's also nice to do some differentiation in topics, right? We did a lot of stock analysis, so now we went a little bit into the maybe a bit the dry stuff to really educate ourselves, and also hopefully we could inspire you as well with this. But yeah, it went quick. So I think it's just time to say goodbye to our listeners and prepare for the week, and have a great podcast again next week.
Perfect. See you all next week, guys. Thanks a million.